The ceasefire may have driven today's rally, but does it create a solid foundation for the bull market to resume? Joining me now are Eric Johnston from Cantor Fitzgerald and Malcolm Ethridge from Capital Area Planning Group. Guys, welcome. Eric, I know you've been, I think, looking at this general corrective phase as a chance to perhaps reload and assume that we're going to blast out of this pretty well. Where do you see it right now?
So I think what we saw, overnight, it was certainly a positive sign. There's certainly the intent from the U.S. side to get a deal and to, put this behind us. I do think from a short-term perspective that there are still risks that are still there. You have a lot of players involved. And, so far, the Hormuz is not open. So there are still risks. And so I think for the, coming couple weeks, we'll see how this plays out. But I think, yes, broadly, we think this is a buying opportunity. We've thought that. We think the economy is in very good shape. We think earnings have a lot of secular tailwinds to them. We've seen a 14% correction in the multiple, so much larger than we've seen in price. And we hit the RSI trigger that we were looking for, and the returns over the next 6 to 12 months, when that happens, have been very strong. It's happened 29 times since 2009. 28 of 29, you were up 1 year later, and 27 of 29, you were up 6 months later. So we think the backdrop broadly is good.
Yeah, just to be clear, that's a low in the relative strength index, indicates an oversold market and usually improves the odds looking forward. Malcolm, from your perspective, what did this corrective phase accomplish, whether it is in mitigating valuations or creating opportunities in individual groups, or maybe just highlighting risks where we didn't see them before?
Yeah, I think if nothing else, it's shown us where the strength really is, where the buying power is really going to come from when we do finally get the all clear, right? I think we're all in agreement here that we don't know whether this ceasefire is the one or the next ceasefire will be the one, but no one wants to be on the wrong side of that trade. We learned our lesson last year with Liberation Day, where with one tweet, basically, all of the tariffs were removed all at once, seemingly, and the NASDAQ alone shot up about 10% in one day. So everyone is trying to position themselves to properly be on the right side of that trade when it comes. And I think it looks like that's going to be in tech more than anywhere else, simply because we're looking at the semis leading today, which is great because we really need them going into earnings. But the tech sector more broadly, if you think about valuations, it's become one of the cheapest places to invest right now, where valuations were back in October at the highs, about 34 times forward earnings, and now we sit at about 20, which is basically where the rest of the S&P is, including tech. So I think it's just the setup is tech is what's going to lead us here.
Guys, 1 second, just stay right there. We are looking at Innovator, a Goldman Sachs company, ringing the closing bell at CBOE in Chicago. That ends the regular trading day for options. Eric, I think there's this open question out there as we try to work our way through and put the, I guess, the most heated moments of the conflict behind us. Maybe oil can calm down. This question of whether the market has already made its peace with some of the pre-existing issues, like the meltdown in software. Software ETF is down 1% today. The potential cracks in private credit. Do you think we've rationalized a lot of those things, or do they wait for us out there?
I think they lurk out there. I think that they'll be certainly back. I think software, is going to be front and center as the evolution around AI, continues. But I think that some of them we're going to work through. So, for example, private credit. You've seen financials act better. I think ultimately there will be losses there, but not systemic. And I think and manageable based on the size. I think around AI capex, I think some of those answers are starting to emerge. We saw the Anthropic numbers yesterday. Probably didn't get as much press as it would have normally because of what's going on with the war. But I think these are all things that can be worked through. And so that's why one of the reasons why I think the outlook, is quite favorable once we get through this sort of near-term issue with Iran.
Malcolm, it's easy to, take comfort for sure in the fact that consensus earnings estimates continue to rise through this entire period. It definitely is making valuations look more reasonable or manageable. I do wonder, though, whether, in fact, those estimates have yet taken account for what may or may not happen in the real economy in response to whether it's higher oil prices or a little bit of the wear and tear on consumer confidence.
Yeah, so I think it's telling today that we got Delta coming out, the CEO of Delta coming out and kind of warning us that guidance might not look so great for the rest of the year. They had about a $2 billion increase in fuel costs so far that they're expecting is going to have a meaningful impact on their earnings. And I think we're probably going to get more and more of those kinds of downward guidance expectation rollouts either during the earnings period or ahead of it. And I think that we have to take into account that that is going to play a meaningful part in how the earnings season actually rolls out. But I also think that I mentioned semis earlier today, and the reason that's so important is because it's really the semis that are expected to be the bulk of the earnings throughout 2026 anyway. Like earnings growth is expected to be about 43% in the tech sector, which is primarily semis, and for everything else, including tech, it's like 19%, I think. And so we really need the tech sector specifically, but the hyperscalers, while they're still spending tens and billions of dollars in CapEx building out AI, it's really the semis. And so we are going to have a mixed earnings picture, I think, is really what we should set our expectations to.